All right. Good morning, everybody. So we got Powell speaking today. It's really the biggest thing on the docket. Yesterday, Mary Daly was able to shake the market up a little bit. It's a little, it's interesting or curious what we're going to get out of Powell today. If he's going to come in with an agenda like he did at Jackson Hole, deliberately dropping this market down, or if he's going to try to aim for a more ambivalent mid-ground operation, don't rock the boat. We do have additional auctions today. Once we're past those, should be fairly open for an afternoon trend day, or an afternoon zero day, I should say. So far, we are firmly back inside the box. Not a surprise, considering we've reviewed this the other day. Volume is in the norms, no real change on that end of things. You can see we had a really narrow IB last night. The IB is the initial balance. So 1 hour time frame from the open. So what we want to be watching for this morning, now that we've set this low, is a retest of the low before moving higher. It's the exact same thing that we talk about on those days where we come in and we're up in the pre-market, and the pre-market has set, a high of the morning. On those mornings, we're looking for the S&P to come in and rally at the open into that Globex high before selling off. So here we would be looking for just the opposite. Coming up off of these lows before the open, dropping back down and testing those lows in the RTH, and then rallying up off of those lows. It'll look a little bit like we had on Friday, where we set a low and then tried to retest that low as we came into the open. Now, I don't know it's going to do that, right? That's just one of the possibilities. We're still above the weekly pivot, and we have an ADR greater than 2% this morning. The weekly pivot is at 38.85, and the previous week's low is at 38.14. So right now we're still right where we were last week. And at the moment we have an MDP, that's a missed daily pivot. What that implies is more than 80% of the time, a market hits the floor pivot. And so when it doesn't do that, we're looking at the other 20% of the time. And there are trade strategies that go with it. They're not my strategies. I didn't make them. But if you were to search for them, you would find it. And it's called missed daily pivot, MDPs. We are inside day breakout at this point to the downside. So any move to the upside is going to have to come through all of those pivot points. Now the S&P is going to be lower than this, right? It's been averaging around 20 points lower than the ES. So in the SPX, when we open this morning, we're going to be below that 3,900 level. That's going to move, or that's going to force them to move the wall down to 3,800. It'll be too late to defend 3,900 because we're already below it. We can see that defense yesterday. And it happened late enough in the day that time was able to defend the market just by going into the close. We didn't get a deeper sell-off. Kind of hard to imagine that they're going to want to put in the work to get this back above 3,900. Because if the ES is now at 3,900, then this is likely going to open somewhere around 3,860 to 3,880, depending on how the rest of the Globex goes this morning. So for a downside move, we want to negotiate that weekly pivot point, 38.85. Then the ADR half, 38.75. Friday's cash open, 38.60. And a full ADR at 38.35. Now keep in mind, with Powell speaking today, he doesn't have to do anything, right? He doesn't owe the market a move in either direction. He can ignore, any inflammatory questions that are thrown at him and just kind of seriously work to not rock the boat. So while it's possible today to see big moves, if he wants to cause them, at this point, there's no reason to suspect that he's got an agenda and that he wants to make the market move. One of their goals has been wealth destruction. And when we had that runaway market from June into August, he did that Jackson Hole moment and kind of shut that market down. But he had an agenda to do that. We're not sitting in a market that's, ripping to the upside, setting new higher pivots. There's no reason to believe that he's going to come in with an axe to grind and try to drop this market. So we need to be prepared for that big move, but we don't need to expect one. Ten-day, 30-minute volume profile. When we're at the top of the profile, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. Right now, we've got a gravity point, or the point of control, 38.62. There's really nothing in the way to prevent us from getting there. There's a mild level of volume sitting at around 38.90. But I don't think it's got enough in it to even remotely act as support. So I wouldn't lean on it at all. It's likely to slow things down and get a first touch, which if you look at that candle right there, we already had the first touch. We hit it, bounced up off of it. So, it's already done. We still have the VPOC from Friday. Came really close to it this morning. But I would argue we haven't hit it. We certainly haven't closed on the other side of it. It's still in play. And now we have one over our head to the upside from yesterday. So if we do make a move to the upside today, 39.40 has a VPOC. All right, what this indicator is doing is it's asking the question, how far away from the 10-day moving average are we? If you think of the 10-day moving average as the starting point, then a market expands beyond the 10 period, either up or down, until it kind of caps out. The 10 period acts a lot like a gravity. So we get too far away from it, it pulls it back. Like the center of the basketball court, everything starts in the middle, right? And then you move in one direction or another. So when we use this indicator, we're really looking for overbought and oversold, even though I hate those phrases. If we get, around 3% to the upside, we're beginning to hit that level where we've moved too far, too fast, and we've outrun the 10 period moving average. We would look for a pause or a reversal, some consolidation while we wait for that 10 to get caught up, or we would look for it to reverse and head back towards the 10 to close that gap a little bit. Same thing with the downside move, right? If we get beyond 3% to the downside. But we're right at the 10. We're not too far away. We're not overbought. We're not oversold. We haven't moved too far. This market right now is very close to the center of the basketball court. So it has the capacity right now to make a big sweeping move in either direction. And it still wouldn't be overbought or oversold. That's the 10-day. And here's the 10-week. Same thing. We're not overbought. We're not oversold. We're very close to the 10-week. And we have the capacity to make a big sweeping move in either direction and still not be overbought or oversold. Looking at the expected move for the week, we are nowhere near the edge of the expected move, which would be the cog line at 38.11. So even the measured boundaries for the week are a long ways off. We're back inside the box. And one thing worth noting when it comes to focusing on something like this is that the market starts to gyrate a little bit. The image that I could give is if you take a toy top and you spin it. Well, at first it spins really fast and it almost stays put, right? It just stays in one spot, spinning really fast. But as things start to slow down a little bit, that top starts to wobble a little bit, starts to drift. That's what price is doing here. And that drift to the downside, and drift to the upside. And if it continues to maintain inside this range, these drifts are going to get a little bit deeper and scale out a little bit more. And what you end up with is a bit of a megaphone pattern. Get this expanding megaphone shape. Rob from the Strat uses a phrase. He says price aggregates, which I find interesting. He's the only one that I've ever read about that used that concept, that phrase. And he talks about megaphone patterns a lot. So if you want to dig deeper into that, the Strat is what it's called. And I'm talking about the guy who created it. Either way, these are fake outs. And we're looking for a resolution of this. Generally speaking, when we get a fake out, like we have up here across the top, we very rarely set a fake breakout like that, come all the way back inside the box, and then come back up and run through it again. Now, I'm not saying that we can't do that because price can do whatever it wants. It would just be really rare to get that fake breakout there and then flip around and come right back up to it and through it without having at least gone down to the other side first. Now, because we've got a lot of econ this week and definitely with Powell today, we could just go right back up there and run through it. At which point, when you get econ, it trumps technical analysis. So, of course, that could be a valid reason why we would see such a thing, but it would only be because of that. Otherwise, in analysis, we wouldn't see that kind of pattern. So our base case at this point is that we're going to go back to the bottom of the box. Probably not in a single day, right? Although that's certainly possible. And then we're looking for an expansion outside of the box to the downside. So this yellow line down here at 38.35, that's a 2% move from the Globex open last night. 2% isn't bad, but if we want to know what extreme looks like, then we need to go a little bit farther. So from that 2% move, let's just add another 1%. And I'm going to tie it in with our mark is really 2.02. So I'll just add 0.98. And that gets us to 37.98. That's really close to 38. So we'll just mark 38. 38 with an overshoot. All right. Same thing in the other direction. That gets us around 40.32, which is a cog line. And now we've got our extreme edges for the day. Now remember, with these extreme edges, we can certainly go more than 3%, right? So even if we were to go that far, there's nothing that says we have to stop there. But interesting enough, when it comes to the indexes, when we make big outlier moves, it tends to end up on a round number, like a 1.5% or 2%, a 2.25%, 2.5%, 3%. Even if it falls back away from that afterwards and say ends the day at 2.92 or 2.95, it still hit that 3% first. So if things do start to get out of control, we're going to target those levels, not necessarily as a close beyond, but as a place to hit, right? Like a target. Also, keep in mind with a 3% move, once we've gone more than 1.5% on the day, we start to get into the algo feed where they'll start to hedge, and they will sell into selling or they will buy into buying. Somewhere around 1.5%, maybe even 2%, since we're looking at a 3% level on either side. You could go ahead and use the benchmark of something like 2%. That'd be where the ADR lines are at. So you could consider, if we get past the yellow lines, we're very likely going to see the extreme line. And if we get there fast enough, we're likely to see it come back in the other direction. That's what happened on this day. Strong expansion to the downside. We got down there really fast. So consolidation through lunch and reciprocation back up in the other direction. It wasn't able to complete the entire reciprocation. It didn't get all the way back to the open, but it made one heck of a nice shot at it, right? Good try. The level that day was 1.29%. Once we got beyond that, the algos kicked into sell mode, and they sold into the selling to try to remain at delta neutral. Tesla's down this morning, not significantly. But it is down. We're going to be focused on that 113 level. If we can get a break below that, then we're going to be looking at Tesla at $100, that round number test. NVIDIA had a really nice run yesterday. Now it's given back a lot of it. And when you get a nice expansion bar like that, you want to keep track of the 50% mark, right? So one way to think about this, $150.45, kind of a little benchmark, and it lines up really nice with this candle back here, which would be 151. No reason to split hairs, right? When you're drawing, don't imagine you're using a sharp pencil rather imagine you're using a big fat dull crayon. So we're not trying to get to the penny perfect here. 150, 151. If NVIDIA is going to stay bullish, it needs to stay above that 151. It's not hard to imagine that that's the line in the sand, considering that's the zone that it broke out of. It would be a little bit of a Busby to break out of that zone, come back and test the zone, and then continue to make its move higher. I'm not bullish in semis, by the way. I'm just looking at what the trigger was yesterday when we were looking at this, and it was getting all that juice, and it was looking really great in the pre-market. It had a really nice follow through. Now it just needs to keep it. Meta, on the other hand, Facebook, basically gave it all back, fell out of bed, and is continuing to sell off. I have a call in that thing that is dead. I'm pretty sure we're going to open and wipe my call out. So it goes. All right, round trip in Apple yesterday. Textbook example, by the way, of a full-on trend day to the upside, a pause for lunch with consolidation, very clear breakdown, and then the rounded reversal all the way back. And any of my coaching clients who've gone through the trend day material would recognize this really well. VPOC means virgin point of control, untouched point of control, VPOC. If you were to study volume profiles, you would learn about that phrase: value area high, value area low, point of control. When you carry those values forward from yesterday into today, or from last week into this week, you would carry forward the point of control if we haven't hit it. So for an example, we wouldn't carry forward that point of control because, well, we hit it. But we haven't hit this point of control, and we haven't hit that point of control. Not yet. This round trip, I believe, was directly connected to some news. We're still looking for the follow through on this to take us back down to the 125. It likely won't be in one shot. I know we came off of that 125 and made it all in a single day, but I don't think we're going to make it back down there in a single shot. And one thing that you want to be concerned of is just like when we were talking about NVIDIA. If this is the zone that we're focused on, it really needs to hold the 50% mark. But I'll give you one more than that. If you're looking at a trend, right? A trend should pull back and continue to the upside. And if it's a trend in a pullback, it shouldn't pull back more than 78.6%. Now, the textbooks will say 618, but the textbooks were written back in a time when they couldn't share data better than an hourly chart, and you had to spend over $1,000 a month to get an hourly chart. So sure, the textbooks say something like 618, give it more room, allow it to pull back more. I would argue in the modern world that we live in, you should be data dependent enough to be able to recognize that the pullback has gone back too far and the 618 is sloppy. We wouldn't need 618, so I don't use 618. 786 works just fine. So with that in mind, this pullback should not have pulled back more than 131.35. And the fact that we went through 786 and 618, and we've come pretty close to the 50% mark, now not only calls the entire trend in question, it calls whether or not we're going to be able to even sustain this breakout into question. The Busby failed. That's for sure. But we still do have one more spot, and that would be that 128. Good morning, Ingrid. Happy New Year. All right, Microsoft also has that rounded reversal, but the move up off of the lows and the follow through was a lot less prescient, certainly less impressive. And Microsoft got hung up on its own trash, even if it did overshoot it a little bit. So 222. We've still got a market maker move in TLT in the bonds. So far, we've carried the inside week breakout. $105.80 is the level that we need to get through. And this morning, we're down at 105 and a dime. So we're actually down here. Now that's good depending on how we can play this morning. So what we want to be looking for in the bonds is that we get that sell off, a nice pullback after the run that we had before continuing the move to the upside, right? That would be a good, clean, healthy market because we don't want a market that just goes straight up. It's dangerous. We want a market that's getting those sweeping pullbacks. So right now we're right around that spot, kind of where we need to be. And you can see that's the sort of move that we've been dealing with. A little bit of a pullback, maybe some stall, the next run up, pullback, next run up. It's a little bit of concern that the pullback or that the expansion is a little smaller compared to this big expansion here. Once we get above 105.84, we're going to be looking for it to maintain above the 106 with some decent support. 110 is still an area of risk or concern. So we got to use that as our target and then focus on using that as support once we get through it. If we get through it, it's been a significant level of resistance. And so far we haven't been able to get through there. The moves this morning are certainly affecting the VIX. I think a little bit of this has to do with what's on the agenda today. Keep in mind that we're expecting a vol crush from CPI, but we very likely could see a little bit of a volatility crush after Powell today. It is expiration day in the VIX too, by the way. And we've got a market maker move because the front series has a higher implied volatility than the back series. Like we talked about the other day, VIX at 25 is what we want to focus on, or VIX below 20 is what we want to focus on. As long as the VIX continues to maintain inside of this range, we're going to expect to see the S&P maintain inside of its range. Right, so we're not looking for a breakdown below, say, 3775 or 3800 area. No breakdown here if we don't get a breakout in the VIX. It's not a new low that we've never seen before, but the VVIX reached a really deep low already this year. Really close to that $72, 72 and a half. It's a level that we haven't seen since 2017. So, a good 5 years, maybe closer to 6 years. Remember the way that all of this works. Very often, once we set these really deep lows, we end up reciprocating back in the other direction. If this is the implied volatility indicator for the VIX, then we're going to be looking for the VIX overall to continue to leg up again, right? So we're not just talking about the VIX going up, but maintaining in a higher structure again, to become more volatile again. We're looking at skew here. The skew model does not quite work in the new world that we're in with these front dated SPX options. The front end being traded the way that it is, with more than 50% of all the options volume in the front week now. Things like the VIX and skew and VVIX, these tools aren't quite working the way that they're supposed to. So this says that we're at really low levels. The easiest way to kind of try to explain what skew is, as is being recorded here, would be the expectations that traders have of the S&P making a move greater than a 1 standard deviation, say a 2 standard deviation. This says the market right now has really low expectations that the market can make a 2 standard deviation move. I don't know about you, but it feels like the market could make a pretty good size move. Not even 30 minutes ago, I measured out a 3% move today, because it feels like the market could make a pretty good size move. So that's one thing that this skew represents, is the trader's expectation that the market could make a big outlier move. Expectations are really low. If the skew is high, then expectations would be really high. But the other thing that this represents is where the curve is at, where the implied volatility smile or smirk begins. So if you look at the implied volatility column, at the money, we're sitting at around 20. As we go farther out of the money, it gets higher and higher. But what we're looking for is where does it turn around and begin going back down again? That would be where the smirk begins. On the call side, that smirk is sitting at around 43 to 4,400, and recognize that we're missing some strikes, right? We're missing a lot of strikes in the middle there. So we just jumped from 43 to 44. But the smirk, we're coming down lower and lower. We get to 1954, and then we start going back up again. That's where the curve flipped. This really matters when you're building out of the money stuff, like out of money credit spreads or iron condors that are built on each end with out of the money options. On the negative side of things, it's not looking that bad. So technology's down more than 0.5%, and biotech, bonds, communications, which normally communications doesn't even get trades in the pre-market. They'll get some after hours, but not pre-market. So not a whole lot there. Looking at what's positive, we got nothing. Right. So we got a market really sitting flat, neutral, not a whole lot of anything. Nothing from the China names either. So this is what I mean with XLC, how we had a print, just a dash, not even any real trading, right? So when we're looking at the watch list in the morning, always take Cloud, CLOU, and XLC with a little bit of skeptical view when it says how much it's moved in the pre-market, because usually they don't get anything. We do have a significant trend line breakover setting up here. We've got a market maker move of 1.74% too. The thing about XLC, I never trade the darn thing. I never trade it. Because look at the prices in here. Even when the market's open, the options in here are trash. So it's good for a tool, right? To look at it, to see what's going on. Just like we use NY Fang, but worthless when it comes to something like, a tradable opportunity. Speaking of NY Fang and KRE, we continue to see divergence in here. It continues to be tech versus finance instead of tech and finance. These two are supposed to be working together. Now, technically, NY Fang isn't, quote, tech, right? It's the monsters of tech. And even then, it's not all tech names. It's got consumer discretionary and, right, think of the names that are in the consumer, the Fang list. Amazon, Tesla, Facebook, Microsoft, Apple, Nvidia. So it's really more mega market cap and not tech. But still, we're supposed to be seeing these two working together, especially if it's going to be a bullish day or a bearish day. When they both started moving to the downside yesterday, we finally had a market working together. But before that, we had some serious divergence between these two. We had a really nice breakaway in the green line yesterday. I continue to point that out just because it's a real easy, obvious signal. It took a while for it to unfold, but the fact that it deviated from the rest of the group, which continued to go higher and flipped over and began going to the downside, that was one of the first warnings yesterday that it was all coming apart. And if you look at what happened in the SPX, it all fell apart, right? Of course, the market breadth and the mega market cap. But if you look at what was going on in finance, it moved to the downside right away yesterday, held it, holding a long VWAP before finally breaking down with the rest of the market breaking down. So when you're trading in the market, you want to try to put all these pieces together, right? That you don't just look at the one thing you're trading, the ES, the NASDAQ, Tesla. They say price is king. Price is the best indicator that you can get. So look at price. Look at as many prices as you can in as many markets as you can. There was the AD failure, right? The advancing versus, or the weighted AD failed to hold above 500. And then the cross down below zero. And if we zoom in on the cumulative ticks yesterday, or in just regular tick, we started out in the green, everything was great. But then we started occasionally breaking down below into the red. And you can really, if you hide it the way that I'm doing it, it starts to really highlight where things began to fall apart. Around 11:30 into 12 o'clock, we started getting those deeper sweeping moves in the tick. my mouse lines up on these candles at the same time that it lines up over here with these deep wicks. You see how it all starts coming together. If we just look at the tick, right, it can be really messy just looking at that. All right, so we got Powell. Keep your eye on the news. It's going to be more impactful than everything else. We're going to look to maintain above this big blue line, 37.65. And the goal for today is just to survive into PPI. CPI and PPI are the big events. CPI this week, PPI next week. Those are outliers. Those are events that we know have the capacity to really shake this market. With Powell, we just don't know if he's going to come out deliberately trying to do something with this market, or if he's just going to open his mouth and do a whole lot of talking without actually saying anything. We just don't know. So that's going to be the number one focus. Keep your eye on what he's saying. Watch Finance Juice, because if he says something impactful, they'll print it in big red letters, the big banner headlines. After him, there's very likely going to be a stalled market until we get to CPI. That doesn't mean that, we can't go anywhere. It's just that's the base case argument, that once we're done with him, we're going to see kind of a stalled market where everybody is sitting on their hands waiting for CPI. So if it does make a big move today because of Powell, don't expect it to follow through. Look to lock in your profits, short duration stuff. No real follow through. Anything that we get today, big move up or big move down, don't expect it to also continue to move in that same direction the next day. So that's what I got for you guys. Be careful, be safe. I'll see you all tomorrow.